My wife insists that the Coca-Cola Company is the stock to buy right now. She said we can be rich buying the stock. I don't buy hype, so I am going to do some study and not follow blindly. But how do I start? The point here is to be rich. Maybe I need to study how much the stock can make me in 10 years' time. Let's do this by estimate. How much is the company profit in 10 years' time? All right, since everyone in finance is telling me to use EBITDA, I am going to use EBITDA. I will extract the data from stockanalysis.com. Think about it. Where do you think this number lands? Will the EBITDA be higher or lower? With EBITDA projection. So in 10 years' time, based on the last 10 years, yearly growth rate of the company, 4%. And assume the growth is slowing down year over year. The Coca-Cola Company EBITDA will be $22 billion in 2034. Right now, people is buying the stock around 19 times the EBITDA. It means if a company now profit $1 a year, people will buy it with $19. With the last 10 years trend, I am assuming people will buy it with around 20 times EBITDA. As I personally think, dividend received is my profit too. I will be adding up the dividend and getting in 10 years' time. Adding up the 20 times the EBITDA and dividend. The stock price is expected to be on $103. Right now, the stock price worth $69, meaning I will earn 0.5 times my investment. Putting in $1,000 will earn around $500 in 10 years' time. Sounds like a bargain. But the finance people also says, best way of investment is to put in trust fund. To be rich, I would need to beat those giant S&P and QQQ. Similarly, I extracted the data from stockanalysis.com. Using S&P 500 stock growth in the last 10 years, I am assuming 10 years later, it will be 2.2K. Giving myself 2.6 times profit, and QQQ will be giving me 3.4 times profit. Now, in comparison, buying the Coca-Cola Company stock sounds like a bad idea. Lower than QQQ. But hold up. After some research, they are saying cash is king. Do you think their cash performance can be better than the QQQ? All right then, I am using the same method, estimating the free cash flow 10 years later. The stock price will end up to be $37, meaning putting in a $1,000 will be losing negative $500 in 10 years' time. Sounds like a bad idea. Lower than QQQ. I personally like dividend. Let's use the same method on dividend gain. The stock price will end up to be $58, meaning putting in a $1,000 will be losing around $200 in 10 years' time. Sounds like a bad idea. Lower than QQQ. Let's average all three methods, taking all consideration, and see how it goes. The stock price will end up to be $66, meaning putting in $1,000 will be losing around $52 in 10 years' time. Sounds like a bad idea. Buying the Coca-Cola Company, we will be losing $52 and QQQ is getting us 3.4K. Seems like buying QQQ is a better idea. Okay, the number seems terrible. But why? Let's study more about their business. To understand more, let's quickly break down the general information and the segment analysis. Starting from the general information. In short, so you look at the Coca-Cola Company. What is their business? It's simple, really. They sell the secret stuff, the concentrates, the syrup. They send it to bottlers all over the world. And where did this all start? Atlanta, Georgia. They are everywhere now. Over 200 countries, territories, massive global reach. Management is key here. They are highly regarded. Why? They drive growth. They get strong margins. They are always diversifying. It's strategic thinking. Look at their future now. Their business frontier. They want to be total beverage, not just soda anymore. They are using digital tools, hyperlocal marketing, targeted selling, their competitive edge, unmatched distribution, truly global. No one else has it. And the brand loyalty, it's iconic. It's emotional. That creates a wide moat. The industry is changing. Consumer demand is shifting. People want healthier drinks, functional beverages, zero sugar options. KO has to follow that trend. And they are embracing digital marketing innovation. Their future direction, becoming that total beverage company. They are moving fast, expanding into low sugar, into no sugar categories. New premium drinks too. The history tells the story. It started with a single sale, An Atlanta pharmacy. They set up a smart system, asset-light franchisees handle the bottling. This gave them huge distribution, without massive costs. Then came the bottle, that famous curvy shape. It became recognition itself. Woodruff started his long run as a leader. They made a mistake though. Remember New Coke? It failed quickly. But the quick return to classic showed something important. Listen to your customers. Correct the mistake fast. They went public, too. People could buy shares. More recently, they streamlined things, refranchised their bottling, freed up their resources. They expanded their portfolio big time. Bought Costa Coffee, bought Body Armor. They are moving into new, profitable categories. That is how you stay on top. Okay, I don't think that's enough. I know their story now. But how did the Coca-Cola Company earn their money? To understand how the business earns, we first look at revenue by segment to determine the source of revenue. North America contributes 39% of the total revenue by segment, followed by Europe, Middle East, and Africa at 17%. Latin America and bottling investments each account for 13%, while Asia Pacific contributes 12% and global ventures makes up the remaining 6%. Next, we examine the compound annual growth rate, CAGR, for each segment to assess growth and identify any significant dips or increases. North America has a CAGR of 10%, which is above the benchmark. Europe, Middle East, and Africa has a 3% CAGR, falling below the benchmark. Latin America shows strong growth at 10%, also above the benchmark. Asia Pacific is below the benchmark with a 1% CAGR bottling. Investments is notably below the benchmark with a -2% CAGR, indicating a decline. Finally, global ventures shows the strongest growth at 32%, which is well above the benchmark. In conclusion, the business exhibits a mixed performance across its segments, with North America and Latin America being major revenue drivers and showing healthy growth, while the performance of Europe, Middle East, and Africa, Asia Pacific, and especially bottling investments, suggests areas that may require strategic attention to improve growth or reverse decline. The exceptional growth in global ventures presents an exciting opportunity for the business's future. So, now we know the potential return and what the business is about. Is that enough to make an informed decision? That is not quite right. You see, buying a stock without checking the financials is like marrying a partner based only on their looks. It's gambling, plain and simple. If you've watched this far, you're serious about investing, and we need to run the numbers. To do that quickly, I developed a 22 checklist that pulls insights from the balance sheet, cash flow, and income statement. Running these 22 checks manually is tedious, so I use the fast download feature at stockanalysis.com to pull everything to Excel for calculation. This is the fastest way to get your insights. You can access the data and my recommended tools through the link below. Use the discount code STOCKSNACK. Starting off with balance sheet. We are checking 7 metrics. Out of the 7, we got 4 metrics with good score. So, we checked Coke's financial plumbing. We found some interesting cracks. First, the debt situation. Their ability to cover their short-term debt with cash. It's not great. They don't have enough liquid cash right now. That's a potential red flag. And look at the balance sheet. They rely heavily on borrowing. Their debt is actually much higher than their equity. It's nearly twice the size. So, they are not self-financing their structure with equity. Not really. That makes them technically vulnerable. It creates risk, but there are serious bright spots. They have 0 preferred stock. 0. This is a good sign. It's clean financing. They don't need those complex high-interest funding methods. Their core ability to grow is also solid. The company keeps piling up retained earnings year after year. This shows they are a compounding machine, slow but relentless. They keep growing even when things are tough. Getty Images and the big win, efficiency. Their return on equity is huge, 43%. They are experts at turning shareholder money into profit, truly top-tier performance, and how they use their assets. Also excellent, they generate serious returns from their physical plant and systems. It's a powerful engine, very high margin. It's a complicated picture, really. Vulnerable debt, but amazing profit generation. Next is income statement. We are checking 9 metrics. Out of the 9, we got 6 metrics with good score. So, we looked at 10 years of Coca-Cola's core performance, and a very clear picture emerged. First, the amazing news. Their gross profit is unbelievable. Consistently around 60%, that confirms a powerful pricing advantage. The brand is the product. They name their price, and look at the engine. R&D is basically nothing, almost zero. This is the beauty of their model. They already have the perfect syrup. They don't waste time inventing new physics. It's a simple, elegant business. Now for the pressure points. They spend too much on sales and marketing. Over half of that big gross profit goes straight to advertising and selling. It's the cost of being everywhere. The product doesn't entirely sell itself. They must constantly shout. It's a huge line item, a noticeable drain on margin. Another point of financial friction: debt. The payback period for their debt is slow. Over 3 years for a cash flow giant, that's heavy. It signals they run with a high level of borrowing, more risk than you'd expect. And the tax situation. Their average tax rate is a bit high, consistently over 20%. It's not a major issue, but it suggests they are not optimizing on taxes, just paying the standard fare. But all that effort pays off. Their net income margin holds strong, right around 20%. That is phenomenal stability. Real proof of their moat. And their growth, that underlying profit per share, it keeps marching forward, slowly, reliably. It's the story of an old giant, high marketing costs and debt, but absolutely unstoppable core profitability. The brand always wins. Next is cash flow statement. We are checking 6 metrics. Out of the 6, only 3 metrics got good score. We pulled 10 years of cash numbers for Coke, and the story it tells is fascinating. First, let's talk about the ownership structure. The stock compensation is minimal. It's less than 1% of their total revenue. This is a clean, good signal. They are not using your shares to pay management. They respect the owner's equity. Now, the quality of their earnings. This is where things get complicated. Their operating cash flow is consistently lower than their reported net income. The numbers on the income statement, they are not all flowing as hard into the bank. It means the quality of the earnings is weaker, a little paper heavy. It's a subtle red flag you need to notice. And the growth picture reinforces this. The increase in their spendable cash, their free cash flow, is actually lagging their profit growth. This suggests consistent high-intensity cash outflows somewhere. Where is the money going? Well, a portion goes to maintenance. Their capital expenditure on plants and systems is steady. It's a modest, healthy amount, less than 20% of their profit. This is the benefit of the asset-light model. Low upkeep. But here is the final remarkable insight. Over 10 years, they have been disciplined with dividends, the total money they give back to shareholders, dividends and buybacks. It aligns almost perfectly with the free cash flow they generate. The ratio is right at 100%. They manage the outflow precisely. No major cash burn issues here. They are essentially committing every last dollar of cash to rewarding owners. That is the entire promise of owning Coca-Cola. Total commitment to the shareholder. The combined financial score is good, 12 metrics with good scoring out of 22 metrics. Now, it is time to make the conclusion. So, is what my wife said correct? Will I lose money buying the Coca-Cola Company stock? By the profit-wise, buying QQQ or S&P 500 is having more potential than the Coca-Cola Company. However, it is having a good financial health. It's a stock worth monitoring. Now, the analysis is complete. Once again, if you needed tools for your investment strategy, give a try to stockanalysis.com. They provided sufficient free tools for you to work around. If you ever want an upgrade, promo code is StockSnack. Institutional grade data with less than $1 a day. One day, one stock. See you again at StockSnack.